Welcome to Inside Economics. I'm Mark Zandi, the chief economist of Moody's Analytics, and I'm joined by the regular crew on Jobs Friday. This is Friday, October 7th. The employment report for the month of September just came out not too long ago, and we've got the regulars, Chris Dorides. Chris is the deputy chief economist, and Ryan Sweet, the director of real-time economics, and Dante. Dante, good to have you aboard. I was just asking Dante, how should I identify you? And he says, you never identify me. So we should just do that again. But Dante is a wonderful labor market, well, economist, period, but focuses on the labor market. And just to remind folks, came to us via the Bureau of Labor Statistics. So he's got an inside view on all this data. Hey guys, how's it going? How's everyone feeling today?
Good.
I'm feeling great.
The bigger question is, how are you doing?
I'm
and
good.
Where are you?
Well, I am in Singapore. I just rolled in. It's now 10 p.m. Is it 10 p.m.? No, 10:30 p.m. Singaporean time. So, it was
12 hours difference. Yeah.
It's 12 hours on the nose. Yeah, which makes it easy. I was just in Dubai before that, and that's 8 hours, and I was in London before that, and that's 5 hours. That's more complicated. I always get confused with the time zones, but we'll have to talk about my travels. I was in London the last week when it was just complete chaos, and then this week I've been in the Middle East, where very different kind of vibe. They're doing pretty well. In fact, probably that's the strongest part of the global economy right now because of the higher oil prices. But of course, when I was there yesterday, or the day before, OPEC announced its production cuts, so we can talk about that. But now,
Ryan, do you sense a pattern here?
Yeah, I'm sensing some
right.
causation here. Yeah,
Yeah.
This is
I'm
not
really worried about
correlation.
Singapore.
Problems.
Yeah, you're right. Everywhere I go, well, see how it goes here in Singapore. And then my last stop is in Tokyo. That should be interesting. Headed toward Tokyo, and then I'll be home. Can't wait. Can't wait to get back to the United States of America. But, well, a lot to talk about today. But first up is the jobs numbers. And Dante, would you mind? Can I ask you to kind of run through the numbers and give us a sense of how you view the numbers?
Sure. I think all in all, it was a good jobs report. It's not as rosy as it's been in recent months, but I think in some sense that's a good thing. Job growth continues to moderate. We added 263,000 jobs in September. The unemployment rate ticked down by 0.2 percentage points to 3.5%, matching its low since the pandemic started. Labor force participation down a little bit, which is probably one of the more problematic things in the report. Still waiting for participation to really tick up, and we backtracked a little bit in September. Job growth is still broad-based. We start to see a little bit of weakness creeping in some expected places. I think financial services payrolls pulled back a little bit, and that's mainly housing market related. A little bit of a pullback in transportation and warehousing, as you've got a little bit of reduction in goods demand happening. Government was weak, but that's mainly a seasonal issue in local government education payroll, so the timing of teachers coming on and off payrolls, coming back to school. But all in all, job growth is still broad-based across industries. Wage growth is still strong, which again is not necessarily a positive in light of everything else that's happening with the Fed. It's a good report.
Well, I don't know. I find it mind-numbing kind of report, right? Because we're in a world of good news is bad news is good news, right? Mm-hmm. I mean, yep. And you kind of said it wasn't quite as rosy, meaning job growth was slower than it has been, but maybe that's a good thing because
right.
that in a world of full employment, and we're definitely full employment, 3.5% unemployment rate, high wage growth 5%, and obviously very high inflation 8% plus. That would suggest that we need to see some moderation in job growth. So in this case, if it's good news, meaning strong job growth, that's bad news, right? Because that means, we're going to make less progress on getting the inflation down to a place where we all feel comfortable with that and can allow the Fed to stop tightening policy. So which is it? Is it, if you're looking at it through the prism of what does it mean for, a slowing labor market, job market, wage growth, getting inflation in, getting the Fed to stop raising interest rates? Is it good news? Is it bad news? How do you view it?
I think it's probably middle of the road. I actually think it's probably not moderating as fast as we would like it to. So I think in that sense, it's probably not great news. Because underlying growth, the top line number was 263, but if you sort of take out the government volatility there, underlying growth is still probably around 300,000, which is obviously much stronger than it was pre-pandemic and much stronger than we need it to be to keep pace with population growth and labor force growth. So I think in that sense, we could even faster moderation would be good news for the Fed.
Yeah, Ryan. So Ryan, want to fill in any holes there in Dante's quick synopsis, and give us your interpretation of the numbers?
No, I mean, the unemployment rate fell for the wrong reason. More people left the labor force. The labor force participation rate, I mean, if you adjust it for population and demographics, it's roughly where we would expect it to be. So I'm not too concerned about that. But to your point, it's the job market's not slowing fast enough for the Fed. And I think why markets are selling off today is that 75 looks pretty much guaranteed. We get the CPI, the Consumer Price Index, next week. That's going to, seal the deal between a 50 or 75 basis point rate hike. But the job market is still too hot for the Fed.
Yeah, well, okay. So I thought before today's numbers, the markets is as implied by the futures markets for the federal funds rate target, the rate the Fed controls, was anticipating or pricing in with a pretty high probability a 75 basis point, 3/4 percentage point increase in the funds rate in November, a 0.5 point increase at the December meeting, and then a 1/4 point rate increase early next year, and then they would stop, and that would, for a while, take a look around. That was before today's numbers. That seemed to be, at least last time I looked, that was what the markets investors were saying. Is that roughly right?
Yeah, so I'm looking at it right now. It's a little higher now. Yeah, the terminal rate is getting up to 4.7% now.
Yeah, but if you just follow through on what I just said, that gets you the terminal rate of 4.75. I mean, 4.5 to 4.75.
I think you need one more hike in there.
Yeah,
do I?
so.
Oh, do I? Okay.
We're not going to beat you up too much, Mark. You've been flying a lot, so.
Okay.
Yeah.
Where's the funds rate right now is what? It's
300 to 325.
Oh, 325. Oh, so if I add another 150 basis points, right? That gets me to 475.
Yeah.
Well, I'm right. Aren't I right?
I thought you said
yeah.
You said 75, 25, 25?
Oh, no. I said 75, 0.5 point and 1/4 point. 75.
Oh, okay.
I you're right.
Yeah.
Okay. Yeah.
I don't get sleep, but I'm still right.
We're making simple math hard.
Yeah.
We're gonna have to go back and revisit the tape there. So.
Yeah. Well, Ben, producer, go when you have a chance. Go back and rewind. I think I said that, but anyway, but that's what the markets were expecting before, I thought. And are they still? They're still expecting that, or are they? I guess with greater.
That's still there.
Still there.
Still there.
Okay. I guess maybe there was maybe it's one of those deals where investors were kind of sort of pricing and are hoping that we get everything looked good in the report to suggest the Fed could maybe take their foot off the accelerator a little bit and not follow through on that. And they got disappointed.
Yeah, well, I think people got encouraged by the JOLTS data, the job opening and labor turnover survey, where we got a big drop in labor demands. The number of open positions fell. So I think there was some growing hope maybe that the Fed can dial back, but I think today's new data kind of squashes that.
Yeah. Okay. All right. Any Ryan, before I go to Chris, anything else in the report you'd call out?
Well, my favorite number, prime age employment to population ratio. It's north of 80. So
but
I think it rose.
Did it go up or go down?
Ticked down by a 10th.
Yeah, but it still remains
Still
north of
high,
80.
yeah.
So
Yeah, no, wait. It's 80.2, right?
Correct.
So, I mean, 80 is kind of the rule of thumb for full employment, right? So 80.2 is we're at full employment, but it doesn't feel like we're that, at least by that measure. Yeah. Okay.
So kind of in the sweet spot.
Right. Chris, what about you? What's your want to fill any holes in the numbers, and what's your sense of the report?
That's my take. No, at any other time, this would be a great report, right? We'd say, oh, much faster than what we need for population growth. But at this time, of course, it's negative. I think what the Fed focuses on is the wage growth. So 5% average hourly earnings is still too hot. I think it moderated a bit from 5.2% growth, but still, that's too hot. And they're going to look at the ECI, Employment Cost Index, to make that final determination. But I think 75 bips at this point is sealed in.
Yeah, okay. I mean, the way I look at it, the report, and why it's so confusing, and why you could, depending on which angle you look at it from, you get a kind of a different sense of it, is there's labor demand and then there's labor supply. On the labor demand side, and this is what businesses are demanding workers, that seems to indicate that that's slowing. So job growth is slowing. We can debate what underlying job growth is, abstracting from the vagaries of the data, but it feels like it's about, not quite half of what it was back in the summer. We're getting 500,000 plus. In fact, last year, I saw this in the report. I think the average monthly job growth in 2021 was like 560,000 or something like that. We're down to something like 420,000 so far in 2022. And it feels like we're, as Dante said, probably around 300K right now. So we're definitely moving in that direction. And then you add to that the job opening labor turnover survey data that Ryan, you just mentioned, the JOLTS, that big decline in unfilled open positions. I'm sure that overstates the case. I'm sure there's statistical, but regardless, I mean, that's like very few changes in economic data are statistically significant.
That was
statistically significant. And my guess is that a lot of those other unfilled positions that are still there, that are kind of above what you would typically see, they're probably soft unfilled positions. I bet they're going to start evaporating here pretty quickly, just like they did in the last month. So it feels like labor. If I just looked at the labor demand side of the report, I'd say it's pretty good. It's actually damn good, right? I mean, the labor market is throttling back in an orderly way, and we're moving in the right direction. You take the trend lines, by early next year will be sub 100,000 job growth, and that's consistent with unemployment moving north and labor market pressures easing and wage growth slowing. But the problem, the reason why investors are so anxious, and why at the moment stocks are selling off, long-term interest rates are up, is labor supply. Because on the labor supply, that was disappointing. Labor force participation declined, not a lot. It went from I think 62.4 to 62.3. So, and that is not statistically significant. I mean, that's bounced around, but unemployment then fell from 3.7 to 3.5, and everyone's now focused on we need unemployment to start moving north to get that to signal that the labor market's becoming less tight, and that wage growth will start to moderate, inflation could come in, the Fed could stop raising interest rates. And that's the disappointment in the report. So, it depends on which part of the labor market elephant you're touching, you get a different perspective on things and why it's so confusing. Does that people, what do you think of that frame for thinking about it? Ryan?
No, I would agree with you. I'm confused about the elephant reference.
Oh,
the labor market elephant.
Well,
there's another Zandyism.
Hold on, wait. You've heard that phrase, right? If I touch the trunk of the elephant, I think blindfold, or I touch the rear end, I've got a different perspective on that elephant.
I gotcha.
Okay.
All right.
Dante, what do you?
I would agree with you.
Oh, you would agree. You would agree with that.
Yeah, I think everything you said was spot on.
Okay, Dante.
Yeah, I agree. I think the JOLTS, the jobs openings data, is just a little bit hard to make sense of right now. One, because you had such a big decline. You've had an even bigger decline over the last 4 or 5 months. Openings are down 1.8 million or so since March, but they're still historically high by a wide margin. So it's you've had this huge reduction, but they're still incredibly elevated. And we've never had a period over 4 or 5 months where openings are coming in while job growth is strong, right? In the 20 years of data that we have on job openings, they've only ever really had a sustained decline when we're already in a recession, right? When job growth is declining. So we have no historical precedent for this idea that we actually have labor demand sort of getting pulled in without job growth also falling. And so I think it's hard to really understand what that means and if it is something we should take seriously.
I
Yeah.
mean, one thing I would add is that we still have that path to a soft landing for the Fed, because I think how I'm kind of charting whether or not we're still on that path is looking at the beverage curve, which is the relationship between job openings and the unemployment rate. And the Fed wants it to fall straight down.
Yeah.
And the jolt date is through August, so it shifted out, but with the decline in the unemployment rate, it likely moved back into where the Fed wants it to be. So it's possible. I'm skeptical, but there is that path to a soft landing.
Yeah. Chris, that frame, this
Yeah.
supply.
No, I'd agree with that. I think that path is quite narrow.
Very narrow, but
The
still
I
exists.
don't know.
and the labor market data is lagging here. So we want to, I think the openings is the more relevant statistic to be focused on if measured properly versus the employment.
And the jolt date is not like that much. It's through the end of August. So it's only roughly 2-week difference between the data that we got this morning, which the reference week includes the 12th of September versus the
Yeah.
end of August. So it's
Well,
only,
but
The
I'm
issue is
confused what
more
you said,
the
Chris.
measurement, right? Hard versus
Yeah.
soft. Is it really an opening? Is it not an opening?
Yeah, I'm confused by what you said, though. I mean,
Yeah. What?
the job openings lead job growth, the decline in the job openings. So what is that? Job openings are coming down rapidly.
That's a positive sign. That's the number
Okay.
I would focus if I have to choose between looking at the unemployment rate or payrolls versus the openings. I think the openings is the more indicative number at this point of where we're headed.
Well, isn't that suggested that that's consistent with a path forward where the labor market eases, wage growth slows, inflation comes in, and we don't have a recession, isn't it?
It's in that
I'm not
direction.
putting words in your
but-
mouth, I know, but
No, it's in that direction, but it's not
Yeah.
enough, right? Even 10 million job openings at this point is far too much, right? So it's good
Well-
that it's coming down, but I don't think it's enough for the Fed to change course at this point or ease up.
right. Right. I mean, I hadn't had, because I've been traveling, I haven't had a chance to dig deep into the job openings numbers. Was the decline in job openings broad-based across industries? Do you know, or was it concentrated?
yeah, Dante wrote up a piece on Economic View about this.
Yeah, it declined in almost every industry. Obviously, some declines were bigger, but I think construction was the only major industry where openings actually increased, which was a little bit surprising to me. But
That's
I think
weird.
it was down
That's very
everywhere
weird.
else.
I'm sorry, everywhere else it was down?
Mhm.
Okay. I mean, one narrative would be that, we saw this surge in job openings when the economy reopened about a year ago, a little over a year ago now, with the vaccination and the end of the end of the worst part of the pandemic. I mean, it felt like every business in the country put up a help wanted sign at exactly the same time, right? So
Right.
that wasn't surprising. And then, businesses are, the labor market is tight. The unemployment rate is low. It's 3.5%. The employment to population ratio for prime age workers is 80% plus. That's consistent with a strong economy. So you keep those open positions open until it's clear that you don't need them. And that's what's happening like right now. It started happening at the beginning of the year, but like now it's very clear that in many of these industries, you just don't need those open positions, and they're evaporating here. They're evaporating as fast as they were put up. And if that's the case, then that would be consistent with the ability of the labor market to ease up here and wage growth to roll over, and we get that path forward without going into recession, with the Fed not having to go on the high alert, and we find our way of a soft landing. Does that narrative?
It's possible.
Yeah.
That's the narrative. It's possible, but I just think it's unlikely.
And why?
It's a very narrow path to fight inflation on the one hand, right? You're looking at the inflation data and you're going to hike because the inflation is still way too high. And have that calibrate sufficiently that you remove just the the open positions without doing damage to the actual labor market, without actually having layoffs, mass layoffs. I just find that the likelihood of overshooting is quite high.
Yeah, but you go back to that narrative. That narrative is just centered around the pandemic and the pandemic. And what's weird, or what's unique, is the fact that the economy was shut down, reopened, and everyone put up these open wanted, help wanted advertise, open these positions up, and getting them back. They went from low to high in a very short period of time, a few months. And what I'm arguing is it's going to come in as fast. It's going to come in as fast because because you just don't need them now. The labor, the economy is starting to slow and labor market. So those open positions are going to evaporate. But
I think we're on your path, your narrative.
Yeah.
We're currently going through that. I think Chris is just saying we're going to get pushed off that path pretty soon.
Yeah.
Well, if job openings are falling that fast, what's the mechanism that stops the
Breaks.
free fall at the right moment? That's what,
Yeah.
So if businesses are that worried, they're pulling back that quickly on openings, what stops that ball from dropping past where we want it to? That's the thing I'm not sure about.
It's because those open positions weren't really that open. They're kind of sort of sitting there. They were just sitting there. Because I had to put them up. I needed people to come back to work. I posted those unfilled positions back when the economy reopened, and they're just kind of sort of sitting there. So it's not a reflection of it, a tight labor, as tight a labor market as you think it does. You see what I'm saying?
Yeah, and it
So you're
doesn't
saying
lead to layoffs.
we lose these sort of like half position, these quasi open positions, but then once we lose all those, then we stop. Is that?
It's not, doesn't mean the same thing, as the fact that they rose to such a high degree doesn't mean the labor market was as tight as that would suggest. Here's the other way of putting it: that the unemployment rate at 3.5% and the employment to population ratio at 80% is actually the really good measure of where the labor market is. It's not any tighter than that. That's how tight it is, and that's tight. And you got to slow the economy, but that's kind of typical, tight at this point. When you're in a business cycle, it's not like excruciatingly tight, which is what you would conclude by looking at the number of unfilled positions. That's what I'm saying. That's what I'm saying. So it's not, therefore, it's still a hard path. I'm not arguing that, because even if it's typical kind of tightness, getting the economy to slow on cue is not easy, but it's not as difficult as it might appear by looking at those unfilled positions. That's the argument I'm making. But we'll see here.
I don't know.
We're at the moment of truth, though. We're at the moment of truth, aren't we?
Absolutely. The
Yeah.
next few months are going to.
Next few months.
Yeah.
But
I wonder if your world travels are coloring your views here.
Actually, I've seen extremes here, overseas, right? I go to the UK. You go to the UK, that is at one extreme. They're in chaos. Of course, with the new prime minister, she came forward with this fiscal package that was deficit finance, tax cuts, and spending increases in a world where the labor market in the UK is arguably tighter than it is in the U.S. It's well beyond full employment by traditional measures, the unemployment rate, and of course, a lot of concern about the economy overheating, and then the fiscal sustainability of the deficit financing, given all the magnitude of the stimulus, and then of course the chaos that triggered because of the rise in gilt yields. Made life very difficult for pension plans here because of some approach they took to managing their liabilities. All kinds of unintended fallout from all of that. So complete chaos in the UK. But then I go to the GCC, the Gulf Coast. I was just in Dubai, and it's they're doing fine, no problem. Life is good, and cranes everywhere. So I've seen both sides of the global economy at this point.
So you mentioned we're at kind of the next few months are going to be critical, but it's going to be difficult to separate the signal from the noise in the data, because Hurricane Ian is going to cause a lot of problems with the employment data.
Yeah,
like jobless claims are going to spike.
Yeah,
they're going to spike. But you can separate that. You can do like UI, US minus Florida, but
right.
it's going to just add some volatility, and it's going to make things a little bit messier to interpret.
What about these job numbers will affect, because it's this by the survey week, which is next week for the month of October.
Right.
Yeah.
What is it
You
going to
can
lift
look-
jobs or hurt jobs? Or,
Let's see what UI does.
okay,
I would
Because
think
I
it
think
still
we gotta
hurt
wait.
a little bit. I mean, the timing is more fit, it's not gonna be as big of
Yeah.
an impact would have been if it hit now or a few days from now, but I think it's still gonna have a negative impact, at least in Florida.
negative.
In the
impact.
past, yeah, but in the past,
yeah.
we've looked at, the timing of storms. If it hits during the reference week, it's significantly disruptive to the employment data, but if it hits before, it's less. It still leaves a mark, but it's not enormous.
But back to your opening point, it may artificially make the employment numbers look a little low next month, which may make us too optimistic, right? I mean, that's actually what we want to see. So it may be a false sense of security that the job market is slowing more than it actually is. So
You don't think the reconstruction will be kicking in by then, and that will create jobs?
Just cleanup.
yeah,
Only the
usually
cleanup would be.
takes a little bit longer, I think, before that starts to really manifest.
Right. Yeah, because are any, I guess, tourist spots are disrupted, and they won't. I guess there'll be layoffs there, and those folks won't be back to work in time.
Yeah,
Yeah.
there's gonna be some business closures.
Yeah.
So yeah. I mean, the BLS made a mention that it didn't affect this, which isn't surprising, it hit after the reference week, but they put a direct message in the report about Ian.
Right. Right.
The Fed meets before the next employment report, though, right? So
Yeah, I
That's-
think they meet
the-
November
or third.
2nd.
Yeah, I think it's the second.
Yeah. So
Oh, that's true. Yeah.
they won't have this BLS.
That's why next week's
Important.
CPI number is.
We'll have ECI though for the third quarter, which is the end of October.
Yeah,
so.
I think
Yeah,
that's
and
the
if you
more
look at
relevant.
And if you look at the quits rate, the ECI is going to be strong.
Yeah, you want to explain that, Ryan?
Yeah, so the quits rate does a pretty good job of, predicting what the employment cost index for wages is going to be in the following quarter. Because if you look at the Atlanta Fed wage tracker, where a lot of the wage growth is for people that are quitting their jobs and in between jobs and things like that. So that's where we're seeing the strongest wage growth, and that, with the quits rate this elevated, the Fed's going to continue to press hard on the
Breaks.
brake, because they need wage growth to slow to pull down the demand inflation that we're experiencing. So, but I'm with you, Mark. I don't know if your view has changed, but our inflation problems are still on the supply side, and the Fed can't do anything about that.
Well, I mean, they got to get labor. Well, they can't get labor demand down, and even
Yeah, they can do that.
objectively speaking, labor demand is still strong relative to kind of trend labor supply. I mean, trend labor supply is 100K per month, roughly,
Right.
in jobs. And we're creating, even today, even in the month of September, 260K. So objectively, they can get that down, right? That's
Yeah.
that they're working to do.
And I think there's some good signs on the supply side. So, the supply delivery times and the ISM manufacturing survey came in, and that's just another indication. Shipping rates are come down a significant amount in the last few weeks. So that's a sign that the supply chain stress is starting to ease. So we should get some more goods disinflation over the next few months,
Yeah.
which we need.
Yeah. Well, we definitely. So,
But then
we
you have
get-
oil. All right.
What's that?
Then you have oil, right? OPEC cutting, right? Oil prices going back
let's
up,
talk
gas
about
prices
that.
going back.
Maybe we should. Well, let's go. Maybe complete the discussion around the jobs, and then let's turn to
Yeah.
oil. But I when I saw the numbers this morning, and I was on a plane, and thank you, Ryan, for sending me the email on the plane, because I couldn't get on
Anytime.
I couldn't get on the internet to see it. I thought, it wasn't. I thought the markets would be kind of mixed, right? Because of the labor demand is very positive from a market perspective, and labor supply is negative. I didn't expect this strong negative reaction from markets, at least early on. I mean, of course, it's early in the trading day, and we'll see how it ends up. But nonetheless, I was a little surprised by that.
It's also after some rallies earlier this week, right? So
Okay, so it's just
so
normal market volatility is what you're
you
saying.
might be giving up some of the gains they
The
had.
old random walk.
Yeah.
Yeah. Right. Okay. All right. Well, I mean, at this point, if we continue to see job growth throttle back, so, end of this year going into next, we're around 100K. And, unfilled positions continue to move south as they have been since the beginning of the year. No more, no less. And the quit rate continues to moderate. It's still very high, but it is more or less moderating if you look through the monthly volatility. I guess the next thing that has to happen, which hasn't happened, goes back to your point about wage growth. That has got to roll over for everything. If we're thinking about this in the context of the Fed's path, the path to inflation back at target without having to go into a recession, that's the next thing that's got to happen here. We got to see that those wage growth numbers start to throttle back. Okay. Anything else on the job numbers you want to call out? I think we covered a lot of ground. No?
Again, outside of the current situation, that it was a good report. U6, the broader unemployment rate is back down to its all-time low. The demographic unemployment rates are quite low. Black unemployment is down. So there's a lot to celebrate in the report from a household perspective, right? So the labor market remains strong from that standpoint.
Yeah. From if I'm a worker thinking about I've got a job and it's a positive, but in the current context, it goes back to that mind-numbing. Good news is bad news. Bad news is good news. Kind of thing. Okay,
that's right.
Yeah, let's talk about oil a little bit, because that obviously is also very important to the inflation outlook and what the Fed's going to do. And the big news here, and I was in the GCC and the Gulf and the Middle East when they OPEC Plus decided to cut its quotas. Did you guys have a take on that? Do you have a view on that? I mean, pretty strong comments coming out of the administration and other politicians in Washington. Do you guys have a perspective on any of that? What's going on there? Chris, do you?
Yeah, I mean, I think it's obviously it's everybody looks out for their own interest, right? So the fact that they cut is not terribly surprising. Oil producers want to keep oil prices high, obviously. In part, you could say it's a reaction to the actions taken by the U.S. in terms of the Strategic Petroleum Reserve releases there, right? From the oil producers' perspective, they might look at that as manipulating the market, and they're just responding to that increase in oil on the market with reductions on their side to keep the price elevated. So I'm not shocked by the actions here. Obviously, it's not in the U.S. interest for these prices to remain high, but for the OPEC producers, it's not unexpected that they took this action. That's my take.
I would concur with that. I thought I guess I can understand from a political perspective why,
of course,
why they might get bashed, right? Because obviously this means higher gasoline prices, and that's politically charged, particularly as you move into the midterm election, which is less than a month away. And there may be some political aspects to what OPEC Plus did. But it feels like, I agree with you, it feels more just self-interest. I mean, oil prices were coming in, right? We were closing in on $80 a barrel, a week ago, before all this talk about an OPEC Plus cut came to the fore. And I don't think that from a OPEC perspective, a Saudi perspective, a UAE perspective, that I think they feel like it's in their best interest to have oil sitting around 90 as opposed to 80. Because 90, I get obviously more revenue, but I'm not killing demand. I'm not going to crush the global economy. But if that's kind of the sweet spot, for prices. So if you look at it from that perspective, their perspective on trying to maximize their revenue, which that is what it is. 90 seems about right. So they cut quotas, and you can kind of calibrate it, because the announced cut was 2 million barrels a day. So they're going to cut quotas by 2 million barrels a day of production. But because many of the OPEC members weren't producing at their existing quota, the actual cut in output is closer to 1 million barrels a day.
Exactly.
a million. And if you do kind of our rule of thumb is every million barrels a day is worth $10 on a barrel of oil. What they did is they took oil from $80 a barrel to $90 a barrel. So that's what they did. And it just feels again, like from if you're sitting in their shoes, they're standing in their, what's the phrase? Standing in their shoes, right? Standing in their shoes, you kind of sort of get it, right? That's what you would do. Hey, Dante, I saw you shaking your head. Do you have a different view?
No, I agree. It makes sense. I mean, from their
Yeah.
perspective, it makes sense to me.
Yeah. Here's
We're
the
still
other.
only talking, it's a small amount off GDP growth in the US though. The
It's more about
ratio.
inflation though, isn't
Yeah.
it?
Oh, no, I agree.
Yeah.
It's more about
Yeah.
inflation, but
It's not about growth at this point. I mean,
I mean, the U.S. is a major producer, right? So they're
yeah,
beneficiaries in the U.S. from higher prices as well. Right?
that's a good point.
right. I mean, if you look at our model of the global economy, if you shock it by $10, you raise oil prices by $10. What does it do to GDP in the subsequent year? I think it's about 0.1% off.
Tenth.
Right? Yeah. So pretty minor, but it goes right to consumer sentiment, psychology. It goes right into inflation. We've been seeing inflation come in because of the lower oil prices and food prices, and now it's going up. So it doesn't feel very good. I will say though, in our forecast for oil prices, and here I'm focused on West Texas Intermediate, we have been assuming $90 barrel oil, through this year going into next. So our forecast has not changed. And now we didn't exactly forecast OPEC cutting like this, but if OPEC didn't cut, then other things would have happened to keep prices up. So, I don't know that it's, even with this move, it's far off of what, we were thinking, at least in terms of the pricing going forward. So, and here's the other thing, this all assumes the global economy doesn't go into a recession, right? Right. I mean, if the global economy goes into recession, and it's not in recession, at least by our calculation, it's close, but it's not in recession. If it goes into recession, global demand will weaken, right? And you'll get prices back, even it'll be in the 80s again, not 90.
Right.
So, okay. All right. It's, I mean, obviously not great, from an inflation perspective, and trying to land that plane on the tarmac, makes the landing even more difficult. But, I don't think it's very different than, expectations, the expectations we've had all along. Okay. Let's play the game. Let's play the statistics game. And I'll have to admit, I've been recently relatively unprepared for this game.
We'll give you a mulligan.
Well, you will give me a mulligan?
Oh yeah, of course.
That's
I mean,
very
when you're
kind.
traveling this much, like we're at,
Right.
Yeah.
the expectation, the bar is lowered.
The bar is lower for me. Okay, I'm good with
Yeah,
that.
I mean, the bar is raised for Dante since he's been, but for you, we can
Yeah,
lower
nothing
it.
but time. Crunch the
Yeah.
numbers, right?
And Dante, you are prepared, right? You've been thinking about it.
I've got a number, yeah.
Okay, you've got a number. Okay, good. All right. So the statistics game, we all put forward a statistic. The rest of the group tries to figure that out with the clues, questions, deductive reasoning. The best statistic is one that's not too easy, that we all get it so quickly. You guys got the cowbell ready, just in case, and not too hard. There you go. Not too hard that we can't get it, and it's got to be well, it doesn't have to be, but it'd be nice if it's apropos to events. What's going on now, recent statistics. So with that, let me turn to Dante. Dante, you're going first for everything in this podcast. So what's your
that's all right.
statistic?
It is minus 2,000.
Okay. Is it in the employment report?
It is in the employment report.
Is it in the payroll
Some-
survey?
Yes.
So it's a change
Is
in
this
job
like an
growth in
industry?
some sector, industry.
It is a change in industry jobs, yeah.
So some industry lost 2,000 jobs in the month of September, and you want us to figure that out. That's your statistic.
It's important, yeah. It's
Oh,
important for labor supply conversation we were having.
Childcare. It's employment at
childcare.
childcare.
I teed it up for him. He said he's
what?
traveling late. There you
That's
go.
impressive.
No, wait.
Right.
These other two guys didn't get it as fast as I got it. No.
Yeah, we were going to get there.
Oh, yeah. Well, maybe 5 minutes down the road you get there.
Yeah.
Come on.
All right.
Okay.
Yeah, it was a little,
The half was it the half bell there?
I'm surprised Mark didn't travel with his cowbell.
I did travel with my loom cube, but I couldn't fit the cowbell in there. But
What's a loom cube?
You don't know what a
Yeah.
loom cube is? LoomCube shines a light on your face. So if I do a TV interview, I can do TV interviews from anywhere. In fact, I did one. I did one yesterday in CNBC Arabia, I think they call it. No, it was in Arabic. Not that I speak Arabic, but it's translated. So it was pretty cool. In fact, I did an interview with CNN. The hardest interview I did all week was CNN. It was about the OPEC cuts.
Yeah.
And the first question was, do you think that OPEC is weaponizing oil? That was the question. I go, oh,
wow.
That's a good way to start an interview.
A good way to start an interview. I'm afraid to go back and look at what I said. But anyway, okay. Why'd you pick that number? Why that statistic?
Yeah, so obviously we've been talking a lot about labor supply as the big thing that we're sort of waiting to see come around. And I think one of the issues still out there is that employment in childcare services is still something like 8% lower than it was before the pandemic. There's still shortages in available childcare for parents who are looking to get back to work. I think we know from other data that there are still people out there, right? The number of people that are out of the labor force but want a job is still elevated by, I think 800,000 relative to what it was in early 2020. So there's still some set of people, whether it's 500,000 or 1 million people that are, sitting out there saying they want a job and there's some reason they're not coming back. And I think one of those key reasons is still, childcare issues are still problematic for a lot of people in terms of cost and availability. And those are obviously directly linked to one another. So we had seen some improvement in childcare service employment, and it's not a big pullback in September, but it's moving in the wrong direction in terms of providing any support to labor supply.
Yeah, I got distracted there for a second. I may have missed it, but what's going on? Why can't these childcare facility centers stand up? I mean, is it simply can't find people at prevailing wages? Is that what it is?
Yeah, I assume it's a combination of, there's obviously no flexibility in work arrangement like a lot of other jobs can offer. You have to be there in person, you have to be around potentially sick children. The wages are not great. They've improved, but they're still not great relative to other available positions. And I think given how many job openings we still have, there's just a lot more competition for a limited pool of workers. So,
oh, that's interesting. I didn't think of that. I know you in times past, you look at labor force participation by different demographic groups, and you looked at the participation rate of young parents, and both male and female, and that was they did decline quite a bit, and it wasn't until schools reopened that they sort of came back, and that was about a year ago now when schools really reopened in September of 2021. Have you looked at that data recently? Do you know what it's saying?
I have not updated it recently. No, I mean, it had come most of the way back, not long after schools broadly reopened. I think there was still a little bit of weakness across parents, particularly of young children, sort of less than 6 years old, which would, point to the, sort of daycare story more than the school reopening story. So I think there's probably still some evidence there, at least the last time I looked, that, daycares in particular were still having a little bit of an impact on the ability of parents to work.
So, but do you still think this is going back to labor force participation, it's down about a point from a pre-pandemic. Do you think, suppose there was no issues with childcare and parents finding the help they need, how much would that really add to the participation rate? We're not talking half a point, are we? We're talking like a tenth or two, something like that.
Yeah, I would lean more towards a 10. I think it's one of the factors. It's it's not sort of the majority factor by any means, I don't think.
Okay.
So if you look at I'm looking at it right now, the female labor force participation rate was 56.8 in September. Pre-pandemic, it was 57.9.
Oh, okay.
Overall for women though?
Overall, I mean, I should look at prime, but
I think prime age women actually hit or was close to an all-time high. I think that might have been last month.
The participation rate, yeah.
I think so, yeah.
For prime
So,
age.
yeah, I think there's certainly some evidence that it's not having a huge impact anymore like it was in the early days of the recovery. But I think it's still a factor to consider.
Still a factor. Yeah. Okay. Go ahead. Go ahead, Robin.
Prime age female labor force participation, September 82.7, pre-pandemic 83.
Oh, so pretty close.
We're really close.
Yeah, really close. Okay. And as I recall, one thing that surprised me about that work you did was that participation rate by men, male parents of young children, was down a lot too. At one point, as much as it was down for women, females. I found that surprising.
Yeah, it actually seemed, if I remembering it, there was a difference in timing. At the very onset of the pandemic, women,
Right.
Mothers got hit much harder. But then it seemed like over sort of the first year of the recovery, that sort of, they improved, but actually, male parents started to pull back a little bit. So it seemed like there was some switching behavior there, just some difference in the initial impact versus sort of the slightly longer term impact of job losses. That
Yeah.
a little bit different for men and women.
Yeah, and I don't know if I said this earlier, but I'll say it again if I did. It feels like to me we can't count on any significant improvement in participation. That we're down a point from pre-pandemic. If you go back pre-pandemic and look at the forecast we were making and others were making for labor force participation, now 2.5 years later, we had participation down. I don't know if it was down a point, but it was down pretty close to a point, I think. So we expected it primarily because of the aging out of the baby boom generation out of the workforce. That was going to happen, pandemic, no pandemic.
If you look just at the forecast of the actual size of the labor force, though, we're still in a pretty big hole, right? I mean, it's recovered to the pre-pandemic high, but if you look at our forecast back at the end of 2019 for today, I think we were expecting 2.5-3 million more people to be in the labor force than there are currently. Yeah, you're right. The participation was coming down, but we're still below what we would have expected in terms of overall labor force size.
No argument there. No, I'm just saying it's not because of participation. That goes to working age population growth, and that probably goes back to immigration, right?
True.
Yeah, and actually, until today's numbers, I haven't had a chance to look, but over the past almost year, there's been a very significant increase in people that are foreign born that are in the workforce and working. That it feels like immigration is starting to pick up again. But it maybe fell back. It might have been somewhat statistical and fell back a little bit in this month, given the data. I haven't had a chance to look, but it felt like we were starting to see some improvement. In fact, labor force growth year over year. I don't know, maybe Ryan, you can look for this month, but last month, the month of August, it was close to 2%. And that's pretty good for labor force growth. Usually it's half a point to a point in a more typical time. So that was strong, but maybe we could take a look. Okay, Chris, you want to go next?
Sure. 1.7.
Are you sure? 1.7?
Yes.
You hesitated.
Debating to give you a softball or a softer ball.
Oh, so this is a softball, but not a softer ball.
Yes.
Okay, 1.7.
1.7. Nope. Oh, do you want units?
Well,
if I tell you units,
you don't have to. It's not 1.7 widgets, though. It's something
It
economic.
is something. Yes.
Is it in the employment numbers?
Yes. It is labor market related.
Oh, but not in today's jobs numbers.
Oh, no.
So it's in jolts.
Yes.
Or something you calculate. Oh, it's jolts. 1.7.
Yes. I think Dante's got it.
Oh, it's
Is the unemployed per job opening?
Yes.
Yeah.
Softer ball, right? So
That's
Yeah,
that.
that's
Yeah,
Or-
I don't know.
1.7 is down. It's down from 2.
Per unemployed worker, right?
Yeah.
All right. So
That's right.
So this is so explain what it is and why you picked it.
It's the number of job openings per unemployed worker.
Okay.
1.7 is still a high number. Prior to the pandemic, it was 1.2. So it got as high as 2 job openings per worker. And now it's come down to 1.7. So it's still elevated. There's been some academic work to suggest this is the most relevant number in terms of assessing the tightness of the job market, and that this number has to come down back to that, at least to that 1.2 level. So we still have a long way to go. So we lost 1.1 million job openings, as we discussed earlier, in the month of August, but we need several months like that to get to something close to 7 million, which would be consistent with this ratio.
Yeah. Wait, what was the peak for the ratio? Do you know? Was it well over 2 probably? 11 million,
Right at 2, I think, wasn't it?
right
I
at
think
2.
right at 2, yeah.
And you're saying 1.2 is historically consistent with full
Well,
employment?
1.2 is what we had prior to the pandemic.
Okay.
And as you recall, that was we already were thinking that was
High.
a hot market. So
Yeah.
probably something closer to 1 is ideal. But
Ideal. Right. Right. Well, I tell you guys, I have this sense that number is going to come in fast right here.
Mhm.
I just think it's coming in, just based on, businesses are now nervous about recession. They're hearing recession, and they're growing cautious, and that you're going to pull those job positions pretty quickly. So the fact that 1 million, and again, that might be overstated, is indicative of all the other millions that are very soft opens, and they're gonna evaporate here pretty quickly.
So you want labor force growth?
Yeah, what's labor force growth?
Would you think it was?
Well, through the month of August, year over year, it was close to 2%.
Yeah, September was 1.99, so 2%.
Okay, okay, but that
I like to go
now
up
going
two
back to
decimal
labor
places.
supply, that's
Yeah.
really strong.
Yeah, if you look like before the pandemic, it was eyeballing the trends, like half that.
No. I mean, before the pandemic, trend labor force growth was a half a point to no more than a point percentage.
Right.
Working age population was growing no more than 1, and participation had, that topped out. So
Mm-hmm.
high end of labor force growth was 1, and we're now at 2. Right? That's pretty good.
Yeah, when wage growth is this strong, it pulls people in. So
Yeah. Well, yeah, but okay. So we got weakening labor demand. We still have reasonably good, I mean, I'd say strong labor supply. And so that suggests things are moving in the right direction to ease this labor market, allow and the next step here has got to be wage growth rolling over. That's got to happen. But okay. All right. I don't know. The more I talk to you guys, the more optimistic I'm getting.
Oh, geez.
that means something's
Or
going to go
maybe-
wrong.
Maybe it's just me talking myself into the optimism. I don't know. That's funny. All right. Okay. Well, that was a good one. That was a good one. Okay, Ryan, you go next.
All right. Well, this is a perfect segue. One number seems optimistic, but reality is a different number. So 2.2% and 0.4%.
2.2 and 0.4.
So one's easy, one's a little bit harder.
Labor
Okay.
market related?
It is not labor market related,
Oh,
Okay.
but this
now,
is important.
is this an economic statistic that came out this past week?
Yes. Well,
Ooh,
what?
I don't want to give you a hint, but
He's not sure.
no, it came out this week, but it's
not
yes, it's a
it's not a
statistic,
release.
yes.
It's not an
It's
economic.
not a release.
Okay,
no.
that's
Okay.
okay.
So think
boy.
you should be able to get this.
Really? And
Mhm.
2.2 is a positive, the 0.4 is a negative.
They're both positive numbers, but one looks
Yeah,
2.2 looks good, but in reality, 0.4 is where we are. I'm giving you
Boy,
really
now I'm totally
a big hint.
confused.
oh, wow.
yeah, this really
It's not a release.
this is like Alice in Wonderland. Yeah.
One's good and one's not good, and it's real.
What's
but it's not.
that? Right. What's he saying?
Riddle me this.
Is it inflation related?
It is not.
Okay.
It's a number you ask about.
It's a number I ask about so many numbers. That's the problem.
I know, but
Yeah, it's like I'm constantly asking about numbers. Okay.
It came out in the last 7 days, or you derived it within the last 7 days, I guess.
mhm.
Is it is it a derivation? Your derivation?
Yeah,
It's not. You derived it. You calculated
Yes.
it. You calculated it. Okay.
Okay.
I know. As soon as you say it, I'm going to say, "Oh yeah, that's right."
Is it a
You helped with
market,
it.
financial market variable?
It is not financial market variable.
Okay.
Okay. Commodity related?
It is not. It was closer to 1 this time last week.
Oh, geez, Louise. Come on, Dante, you should know this.
It's
You're the one that
Last
asked
week.
for
So
it.
You
it's
want
a
a big
weekly
hint?
number. It's UI claims type of,
the daily number.
it's a daily number.
Oh, wait,
Oh, come on, Mark.
wait, really? Okay, is that something with inflation No, you said it's not inflation related. It's not, oh, it's a
It's-
bond, it's not inflation expectations related. Anyway,
If
no.
you open up it's plastered right there in a big blue circle.
Oh, I know what it is. I know.
High frequency
Yeah,
GDP.
yeah, GDP.
GDP. So our
Well-
tracking estimate for third quarter GDP went
Okay.
from 1% to 2.2%. But the reason for the increase and why
Yeah.
it's misleading of the strength is that it's all trade. So the trade deficit really narrowed in August. And if you exclude trade, net exports,
Oh,
GDP is really tracking 0.4%. So just like how we discounted the drop in GDP in the first half
Yeah.
of the year because of big swings in inventories and trade, we kind of have to discount the strength in Q3 because it's all trade related.
Yeah, I
interesting.
read that piece you wrote. All those numbers sound so familiar now, and that's why.
There you go.
It's interesting. So it's
I don't know.
basically the GDP has really gone nowhere, since
Exactly all year.
all year long. It's just basically flat.
Mhm.
That's an amazing thing. Okay. And but the reality is GDP in Q3, and now we're into October, we're gonna get more data, but it feels like it's going to come in positive.
It's going to come in positive.
And it's going to come in around 2%-ish, something like that. We got more.
Correct.
data to go.
Yeah. But some of the the
Sounds like
weakness is
more
starting to
arguments
broaden
for
out.
a weak productivity story, right? I mean, that's
Oh,
Oh,
yeah,
very-
yeah.
ongoing
absolutely.
weak productivity
Yeah.
growth. Sounds like something like that.
Ouch. That
Ouch,
stings.
yeah.
That stings.
Inside comment there, or Barb. That was a Barb.
That was definitely a barb.
Because Dante's a productivity skeptic and Chris is a productivity
Optimist.
optimist. And he's,
Filing on
he's-
jobs, but
right now he's not
GDP
looking
still
so
on the-
good. He's not looking so
No.
good. Okay, all right. I got one
All
for
right,
you.
Mark, let's
You
hear
got one.
yours.
I got one for you. I'm not sure. I'm gonna give you a number to make it a little harder. If I give you the exact, I'm giving you a little bit of a hint by telling you all this. If I give you the exact right number, which I may have to do if you found her here.
So wait, you're giving us a wrong number?
No. I'm gonna round.
Okay.
Oh, okay. All
I'm
right.
gonna
It's a
round.
rounded number.
It's a rounded number, and the rounded number is 30,000.
Employment related?
Employment related.
It's
Yeah.
a sector of employment,
No, it's not in the jobs report.
not in the
It's
jobs report.
Not in today's employment report.
Is it in JOLTS?
It's not in JOLTS, the job opening labor
UI
turnover rate.
claims.
Oh, is
Well,
this Challenger layoffs?
Yeah, yes, it is. Ding, ding,
Ah.
ding. He gets a bell. It definitely gets a bell. Yeah, very good. Gets a cowbell.
Wasn't it 26,000?
No, it was
Oh, no.
I'm
It
29,989.
rounded.
Oh, okay. All right.
You can see why I didn't want to say that, because if I said that, you would have gotten it right away, probably.
Yeah.
Right. Yeah. So I don't really, do you pay much attention to the layoff announcements, the Challenger layoff announcements? Do you look at them?
Yeah, I look at them. It doesn't factor into like the employment models because these are announced layoffs, not necessarily layoffs that have occurred. And businesses can change their plans. Like, so they can announce 29,000 layoffs, but only go through with half of them.
Yeah, I'm with you. I'm beginning to think, though, we need to pay more attention to that in the current context, right? Because the next thing that's got to happen is layoffs, more layoffs. And
Mhm.
again, that sounds really weird to say. It's bizarre, say that. Good news is bad news. That's kind of sort of what we're saying here. But layoffs are just incredibly low. You saw that in the initial claims for unemployment insurance. They're hanging around 200K. I think our rule of thumb is 250K per week is consistent with a healthy, good economy. Not too tight, not too cold. And we're at 200K. Is that right? 250K. Should we put that stake in the ground? Is that the number we should be using? 250K on UI claims, Ryan?
So when I estimate the break even, so that,
Yeah.
I mean, I think you're right. 250 is a healthy, like we're creating jobs.
Healthy.
Yeah.
So that kind of line in the sand where
Yeah.
claims are consistent with no monthly job growth is closer to 280.
Okay. Yeah. But
So
if you
I
want-
would agree. 250 is
Yeah.
good. Yeah.
250 is kind of just
Sweet
right,
spot.
sort
Yeah.
of. But 200 is like, that's no layoff.
Too low.
Very
Too
tight.
low.
And the layoff announcements, even though you're right, they may not translate, and depends on timing and everything else, into that might be worthwhile as a leading indicator in the current environment where businesses are growing more cautious, where they're pulling unfilled positions. The other thing that you would expect them would happen, you'd see more announced layoffs. And we actually, that 30,000 or 29,989 to be precise, in the month of September was pretty high, by recent historical standards. It's been incredibly low. I think you add up all of the layoff announcements so far this year through the month of October, it's a record low, 10 months into a year. But that number, that 30,000, that's pretty high. And so if we start seeing, I would expect to see more of that as businesses are growing more cautious here and worried about recession. And that would be an indicator that, we are starting to see at least a more normalized level of layoffs. And that would, again, be another way to get job growth down into that sub 100K that we need to get unemployment moving north and taking the pressure off of wages and ultimately prices. So I think we might want to start focusing on, is there another source of layoff announcements? I think there is.
You get what are they called? Warren
Warren
reports.
Yeah, we might want to take a look at
People
that.
can monitor
too.
those.
Yeah, we'll start monitoring those to take a look at that.
And they're available. Dante, are they by state?
Yeah, I think, right, you're required to report to the some state office if you're planning to lay off above a certain, I think it's above 50 employees. There's some threshold. So if you're going to lay off 5 people, you don't have to file a warn notice. But if it's above a certain threshold, you have to file with the state.
Yeah, and
Those layoffs are concentrated in tech and retail, right?
Yeah.
Is that-
Yeah, healthcare, I think too, a little bit in healthcare, but you're right, mostly
Okay.
tech, which consistent with the layoff announcements, right? The tech companies have been, out front.
Yeah, I talked to a lot of the Bay Area lenders, and they have a very different perspective than the national view when we talk about layoffs in the job market. Right, they're seeing, because tech industry is right there. So
yeah, no, you're right.
and they
And of
see
course,
that
that's where
feeding
house
into
price
housing.
declines have been
Yeah.
most affected, right? In the Bay
Exactly.
Area,
So
or
that's what they're saying, is that
Ah,
there's definitely a regional concentration
right,
of these layoffs. So.
right. Okay. Why don't we, whenever I say it's going to be a short podcast, it never is, because we have so much fun talking about these numbers. But it is getting a little late in the day here in Singapore. I'm coming up on midnight, and by the way, I have not eaten dinner, so I'm like, and I got all these snacks. I got pistachios right here. I got fruit and nut bar from London. I got some dark chocolate. I took off the
From
plane.
London. Did you declare that at the border there? Or?
Did I need to? No.
It's,
See, Chris
it's
and I
a
are gonna
food
have-
item, I think.
Yeah.
Well, this is like a pound or something. Well, now, this used to be like, took $3. Now it cost me $1, because of the dollar so strong. So actually I bought 2 of them. Here's the second one right here. But we probably should wind down this conversation.
Are you going to be able to find somewhere to eat at midnight?
Well, in fact, yes,
Singapore.
At
City that
24
never
hours,
sleeps.
I can get something.
Oh, that's good.
Yeah, we'll see how that goes. I got a 24-hour gym, so I'm contemplating, should I go run before I have my dinner? What do you think? Would you think less of me or more of me if I went for a run before dinner at midnight in Singapore?
What do you have scheduled for tomorrow?
Actually, interestingly enough, Steve Cochran, our good colleague, is here in Singapore. He manages our Asian. He and I known him for 30 years. He calls himself 007. He was the 7th employee of Regional Financial Associates that, is the precursor to our company now. And he and his wife and I are going to go to the botanical gardens here in Singapore. So,
Oh, those are famous.
Well, then you have to go for
Yeah.
a run. You got anything on your plate?
What's that?
Yeah, then you got a whole free day tomorrow. You got to go for a run.
Okay, I'm going to go for a run.
Well, it depends what time they're going to go to the gardens.
9 a.m. He starts early.
Oh no, go to bed. 9 a.m. You haven't seen, no.
That's funny. We'll see how wired I am, but we're not done yet. So
No.
let's, yeah, we got more to go here. I want to know two things. First is, where do you think the terminal rate for the funds rate will be? Terminal rate being, what is the highest the federal fund rate is going to get? Bonus, if you can tell me when that's going to be and how long it's going to stay there. And then I do want to hear again your probability of recession over the next 12 to 18 months. So we should reprise that. Should I start with the most pessimistic person on the podcast? Okay, let's get it over with. Ryan, what's
How am I the most
Oh.
pessimistic? No, it's Chris. Chris is the
No,
most
no,
pessimistic.
I thought you were.
No, Chris's
Chris?
recession odds are higher than mine.
No, come on.
No, I don't. Is that right?
Are you sure?
Oh.
They might be. They might.
All
be.
right.
think
Okay,
they
let's
are.
go with Chris. Chris, okay. So what do you first give me your Fed forecast and then give me your odds of recession.
All right. Fed forecast 4.25% to 4.5%.
Oh, wait.
Definitely.
That's less than what markets are anticipating.
Correct. I don't think they'll
Oh, you think the economy's
We'll
going
make
to
it all the way.
break before we get there?
Yep.
Oh my
So he is the
gosh.
pessimist.
He is. Oh, Lordy, you are pessimistic. Okay.
realistic.
Oh,
I like to say.
So you think a recession is going to start like imminently?
First quarter.
First quarter.
That's pretty soon.
That's pretty
Yeah.
imminent. That's 2 months from now.
Well,
Oh no.
sometime it could be at the end of the first quarter. I'll give you some hope. Right.
There you
End
go.
of the first quarter.
Maybe we have 5 months instead of 2 or 3. There you go.
Oh.
Wait, when do you get back to the US?
Me, I get back a week from now. A week from Saturday. I come back.
All right, so the recession's going to start right around then.
Yeah, right.
Trouble seems to follow you everywhere.
Exactly. I'm trouble. I'm trouble everywhere I go. Oh, geez. I should write that up, shouldn't I? That would be good. All right. What's the probability of recession then over the next?
70% in the next year.
Well, you're saying in the next 6
Yeah,
months.
yeah. Well,
Yeah.
give me some.
I'm giving you some slack. Yeah,
Give me some slack.
70% over the next 12 to 18 months. Let's say through the end of 2023, just around it. So 70%.
Okay, I'll keep it there. Yeah.
70%. So Chris, let me ask you this. You would, did I lose you?
No.
we're-
I'm
we're
still
Oh,
here.
sorry, I hit the wrong button. You would change our forecast to a baseline forecast to have a recession in it now.
I would.
You would.
I mean, you're already getting pretty close there. I think we have first quarter going negative. I mean, it's
Do we?
not a lot. But
Not on jobs though, do we?
job,
No.
we have unemployment
Un-
creeping up.
Yeah.
right?
Oh, well, on year-over-year basis, GDP goes basically, it might go a little negative actually in Q4, Q1, given the weak GDP in the first half. of the year.
Annualized.
Yeah. But
At least
I don't
that's
think
the
we have-
last I saw. I
don't think we have jobs going negative though in the forecast.
No.
right?
No.
Sure we don't. Yeah. Okay, interesting. All right. I'll go with Dante. Do you have a view on the Fed?
Yeah, I think I'm in line with the market. I think 4.5 to 4.75. I think that makes sense to me.
And that's the terminal rate the highest is going to get. And you think it stays there all next year?
My recession odds are pretty high, so I'm not sure it stays there all next year.
Oh, okay. What's your recession odds?
I'd probably go 65%. I'll hedge a little lower than Chris, but
So you
it's
wouldn't
creeping
change
up
the
from where it
baseline.
was. a few months ago.
You wouldn't change
I
the
wouldn't-
baseline forecast.
Not today. I'd probably wait another month or two and see where we are. I think
Yeah.
a little bit more information would be useful here.
Okay. All right. I hear you. Okay. And Ryan?
There's no collusion, but I'm exactly with Chris. 70% probability of recession, 4.25 to 4.5. They can't get any higher.
Well, okay. So wait, they're going to raise the funds rate. Well, you tell me what they're going to do with the funds rate here in November.
75,
What are they going to do in December?
50.
What are they going to do after that? Nothing is what you're saying.
Mm,
That's it.
That's it.
So that means we're going into recession early next year.
Correct.
That's what you're saying.
Yeah, I think they're going to see the economy is really slowing down in the second and late this year, early next. Pause at 4.25 or 4.5. Leave it there for an extended period of time until it's very clear that the economy is in a recession.
But,
and then
but
start
it
to-
sounds like their only reason they would stop is if it really looks like either two things: a good thing, inflation's coming in, or second, what you're suggesting is the economy's falling apart.
Mhm.
So you're saying the economy is going to be falling apart early next year, is what you're saying?
Yes.
That's what
So
the
I would
implication-
put a recession. I would put a mild recession in the baseline.
Okay, what beginning in Q1?
Wow.
That's what it sounds like you're
Precise timing.
saying.
Yeah, I would
right?
say the first half of the year.
Yeah, but okay, well, how's that consistent with them not? So they're not going to tighten it after December. They're going to
I
stop.
don't think so.
Okay.
But if I'm wrong and they keep tightening, then the odds of a recession go up even higher. So
So what's your probability of recession?
70.
70. And you were there last time we chatted about this, weren't you?
I
70?
think I was 65.
Oh, 65. And Chris, you were 70 or you
70.
You were
Yeah,
Right, and
the
I think
warning
you were
signs.
at 70, you went back to 65, and
Yeah.
Now
Now
you're
I'm
back
back
to
up to 70.
Oh
I
man,
mean, did you see Chris's chart with the leading indicators?
no. But you mean his no, I'm not sure.
The
No.
6-month decline? Like Chris can
6-month
elaborate. but
decline in leading economic indicators.
Oh, that one. Yeah, you want to explain that, Chris?
That's it.
Oh, what
It's
is
a percentage
so-
percentage change in over 6 months of the leading economic indicators produced by the conference board. We've never not had a recession when that change is as large as it is now.
Right.
Right. So those leading economic indicators are signaling high probability of recession going
Yeah,
forward.
and that's I guess the yield curves in there, the stock market's
yield
in
curve.
there.
Housing
Credit-
permits.
housing permits
Yeah,
in there.
it's
Yeah.
an amalgam of
Yeah.
a number of different,
Oh man.
and there's
Oh,
weakness all around, right? So-
Yeah. There's by definition there's got to be weakness, right?
Mhm.
The
Yeah,
economy's gotta
you're
slow.
saying it's by design.
It's by
right?
design. It has to happen. Otherwise, you can't get wage growth down and inflation back in.
That's right.
Wow, that is so.
And what we're debating is
interesting.
does it go too far, right?
Yeah.
Yeah.
Right, you're arguing it's a controlled weakness. We're not in free fall yet, right? That's your.
Yeah, it doesn't feel like free
great-
fall to me.
Yeah.
All right. So
Well,
what's
okay,
yours, Mark?
I say 4.5 to 4.75 terminal rate. So 3/4 point in November, a half point in December, 1/4 point in February. Those are the meetings, and then you're 4.5 to 4.75, and they just hang
Isn't
out.
there a meeting in January?
Yeah,
I thought it was
They always meet in
February.
January.
Oh, it's late January. I think it's late January. Or
late
Oh, okay.
January.
All
Yeah,
right. Late
I think you're right.
something. And then they hang out there and take a look around, see what's going on with wages, what's going on with inflation, what's going on with jobs, things that they're focused on. And if everything is coming in, that's the end of the story. And that's what I would consider to be the baseline. No recession. It comes close. It's going to feel uncomfortable. Unemployment's going to move higher, but we don't actually go in. We don't get the kind of job loss you would need, I think, to characterize the environment as a recessionary environment. You might see a month or 2 or 3 with job loss, but it's not going to be persistent 3, 4, 5 million job loss. I just don't think you're going to see that.
So do you think we're going to get an inverted policy curve? So the 10-year minus the Fed funds?
I think there's a reasonable chance we don't, because if we do, that's just one more indicator. Then every single indicator I know would be signaling, recession, except for the kind of that's all the long leading indicators would suggest recession. Consumer confidence doesn't suggest recession within 6. That's 3-6 months, and that doesn't suggest recession in 3-6 months. And certainly the unemployment rate doesn't suggest recessions. Like, that the other, Chris, you did a great job. What was it? If the unemployment rate rises by more than 0.5 point within a 3-month period, then we're in, right? And it's in,
Over a year, right? 0.5 point over a year,
is it 0.5 point over a 12-month period?
over 12 months.
The
yeah.
12 months, okay, over a 12.
That's really confirmation that we are in, right? That's
Yeah.
Yeah, we're already in.
That's
But
not
it pegs the
leading
timing of
indicator.
recessions, though, right? Very accurately.
That's
if I
right.
recall.
The start.
It
Yes.
pegs the start of the recession, the month, very, very accurately.
Right.
So that's not signaling anything.
But that's going to be late to the game, right? But by the
Oh,
time we
yeah,
hit
yeah,
that-
yeah, yeah. That's so we're talking about kind of long lead. There's intermediate lead. I'd say confidence is intermediate lead. And I'd say the unemployment rate is no lead. It's just
Coincident.
we're in recession,
Yeah.
But you can see the unemployment rate. The unemployment has to start rising to get it up a half a point in a year, right? So,
Right.
we can see it headed in that direction. And right now, it's not headed in that direction.
That's right.
It's going in the opposite direction. It went down 3.5%. Yeah, I'd say, I'd still say 50-50 over the next 12, I would say through the end of next year, 50-50. So, so the narrative is the Fed pauses after the the hike in early next year. They hang out, they see what's going on, and they'll get confirmation at that point by summer of next year that wage growth that the job market is moderating, easing up. Wage growth is rolling over. Inflation is going to keep coming in. So all the things that inflation expectations are well anchored. They remain well anchored like they are right now. And it's going to be painful. It's going to be close, but we don't get the kind of the job loss that I think you would need to characterize the environment as a recession. It may come down to just a judgment call as to what is a recession. This debate we've been having, what is a recession? Because maybe a recession without job loss. That would be unprecedented, but perhaps that could happen. Perhaps the Business Cycle Data Committee of the National Bureau of Economic Research could decide it's a recession even if you don't have a lot of job loss. I'm not sure.
Like a modest job loss. What if we lose 200,000-300,000 jobs, right?
Yeah, would you consider that a recession?
Normally, but if everything else is falling apart.
Right.
But you could have a month down on 300K and it's just a statistical fluke, right?
Yeah. So that's the question.
Is that a recession? A recession to me is broad-based, persistent decline. It's got to have job loss, you would think, but I don't know. Maybe there'd be a different perspective on that in the current environment.
So I still owe you that path for the Fed funds rate. You want me to do based on 4.5 to 4 3/4 being the peak?
Yeah. Oh, yeah. Yeah.
Okay.
Yeah.
All right. I'll send it to you over the weekend.
That's what markets are expecting right now, certainly as of today, right?
Oh, yeah.
Yeah.
Yes.
Yeah.
That's in line.
I think that's most likely baseline. Okay. Oh, boy.
All right. Go for your run.
I know. I'm bummed. You guys are bumming me out. All right. Okay. Well, can I ask one more question, and then we'll end. When you look at all the different projections being done out there, roughly speaking, consensus is now what's the consensus? Well, do you think it's substantively people think we're going into recession or not? Or is it 50-50? Curious what people are saying.
Well, I don't have a scientific survey here, but certainly if we look at just anecdotally at some of the Wall Street firms, other firms, does look increasingly, if not a recession, certainly a significant slowing.
Oh, yeah.
So the consensus
But
for, go ahead, Chris. I'm sorry.
I was going to, but I do think that majority now is pointing to a recession. But what do you see, Ryan?
So the consensus for GDP growth in 2023 is 0.7%.
Oh, that's our forecast.
Mhm.
It's exactly our forecast.
And I'm eyeballing it, maybe 15 to 20 that have individual forecasters that have a decline in GDP out of 75.
Okay. So
Okay, that's
okay. All right. So it feels like we're in the middle of the consensus. That's what it feels like.
Correct. Mhm.
Yeah. Okay. Meaning me,
You.
not you guys.
You Maverick.
Me, Maverick. Oh, it feels so lonely. Oh, geez. This is killing me. All right. Well, I think we're at the moment of truth, though. The next few months, we're going to figure out which way this thing goes. Okay. With that, we're going to call it a podcast and talk to you next week. Take care now, everyone.